Welcome back, my friends. Commercial real estate is in trouble. A banking crisis will make it worse. You have all heard of the many dead shopping malls across the country. And, if you follow this channel, you know of the retail ice age. And you have all probably driven past strip malls with many empty stores. Maybe you have heard of the soaring office vacancy rates in San Francisco and Los Angeles. And the defaults on mortgages on skyscrapers. Well, it looks like commercial real estate is the next shoe to drop. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. If there is anything commercial real estate owners don't need right now, it's a banking crisis. Big owners of property around the country are under pressure from the Federal Reserve's aggressive campaign to raise interest rates. Rising interest rates have raised borrowing costs and lowered building values. These institutional property owners also had lots of space still sitting empty in city centers as a result of more hybrid and remote work arrangements resulting from the pandemic. Now they face the prospect that beleaguered banks, especially smaller ones, could get more aggressive with lending arrangements. This gives the big landlords even less room to breathe as they try to refinance a mountain of loans coming due. This year, roughly $270 billion in commercial mortgages held by banks are set to expire. And $1.4 trillion over the next 5 years. There were already liquidity issues. There were fewer deals getting done, said Xander Snyder, first American senior commercial real estate economist. Access to capital was getting scarcer, and this banking crisis is almost certainly going to compound that, Snyder said. Most of the banks that hold commercial real estate mortgages are small to mid-sized institutions that are experiencing the most pressure during the current crisis. This began this month with the high-profile failures of regional lenders Silicon Valley Bank and Signature Bank. The pressure on regional banks continued Friday, stoked by intensifying investor pressure on German lender Deutsche Bank as the cost to insure against default on its debt soared. Smaller banks began ramping up their exposure to commercial real estate in the aftermath of the 2008 financial crisis. For those of you who remember, the 2008 financial crisis was triggered by a housing bust. Smaller banks stuck with it even after the pandemic emptied out many city center properties, and other forms of borrowing provided by commercial mortgage-backed securities and life insurers dried up. Signature was among the banks that made some of these bets. It was an aggressive lender in New York City to office towers and multifamily properties. By the end of 2022, it had amassed nearly $36 billion in commercial real estate loans. Half of which were to apartments. That portfolio comprised nearly one-third of its $110 billion in assets. More than 80% of all commercial real estate loans are now held by banks with fewer than $250 billion in assets. These loans now comprise the highest percentage of industry loan portfolios in 13 years. There's a lot of commercial real estate that's been financed over the last few years, said BlackRock Global Fixed Income CIO Rick Rieder. When you raise rates this quickly, the interest-sensitive parts of the economy, and particularly where there's financing or leverage attached to it, then that's where you create stress. That's not going away tomorrow, said Rieder. Commercial real estate, he added, doesn't represent the same type of systematic risk to the economy as housing did during the 2008 financial crisis. But there are isolated pockets that can lead to contagion risk. 2 early warnings of the danger that rising interest rates pose to commercial real estate came last month. Giant landlord Columbia Property Trust defaulted on $1.7 billion in floating-rate loans tied to 7 buildings in New York, San Francisco, Boston, and Jersey City, New Jersey. That followed a default by giant money manager Brookfield Asset Management on more than $750 million in debt backing 2 52-story towers in Los Angeles. Forced sales of more trophy buildings at large discounts are expected in the coming years as owners struggle to refinance at affordable rates. Sellers will want the price that everyone was getting back in December 2021, and buyers are kind of even afraid to buy something right now cause they don't even know what the price of these buildings are, Snyder said. Banks were already squeezing terms on commercial real estate loans before this month's chaos. According to the Federal Reserve's latest Senior Loan Officer Opinion Survey, nearly 60% of banks reported tighter lending standards in January for non-residential and multifamily property loans. Bank lending standards had already tightened significantly over the last few quarters to levels previously unseen outside of recessions, presumably because many bank risk divisions shared the recession fears that have been widespread in financial markets, according to a note last week from Goldman Sachs. More tightening of lending standards expected as a result of new bank stresses could slow economic growth this year, Goldman said. Fed Chair Jerome Powell agreed with that view at a Wednesday press conference following the announcement of another rate hike. He said he also anticipates a tightening of credit conditions as banks pull back, which will help cool the economy. We're thinking about that as effectively doing the same things that rate hikes do, he said. But he said regional banks with high amounts of commercial estate loans were not likely to become the next Silicon Valley Bank. We're well aware of the concentrations people have in commercial real estate, he said. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized. The larger commercial real estate world is still absorbing the shock of the Fed's aggressive campaign, according to Marcus & Millichap CEO Hessam Nadji. The effects may not pose a systemic risk, he added, but they will add to the industry's many challenges. Commercial real estate has been through a pandemic, very rapid recovery, then massive tightening of financial conditions unlike anything we've seen in modern history, he said Thursday. The last 3 years have moved the industry through a significant roller coaster. And, if you follow this channel, you know about the trouble at Blackstone and Starwood. The Blackstone and Starwood real estate investment funds are what are known as REITs. What is a REIT? For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. So, many investors have current needs for cash and need to liquefy some of their assets. Blackstone launched the Blackstone Real Estate Income Trust in 2017. Blackstone's fund is called BREIT, which stands for Blackstone Real Estate Investment Trust. The fund is designed to cater to rich individuals. And these rich investors are always looking for better investments. High net worth investors were looking for better returns in what was then a near zero interest rate world. Assets flowed into the fund and it was a success, at least for a few years. The Blackstone REIT amassed $68 billion in assets. Then, in 2021, Blackstone launched a fund called BCRED, which stands for Blackstone Private Credit Fund. The real estate market in the United States has reversed course. And investor sentiment is turning bearish, to say the least. I am concerned over the fund's growth, said Bill Katz, a research analyst at Credit Suisse in a report to clients. But most REITs invest in commercial real estate. Blackstone has taken heat over the past week for limiting withdrawals from the $69 billion private REIT. And real estate is not a highly liquid investment. So, the fund needs to make some sort of judgment as to how much cash it should make available for redemptions. And, in this case, investors in the fund want to take out more money than Blackstone can make. As you might imagine in a degrading real estate market, publicly traded REITs have gotten slammed this year. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. That is especially true of the real estate holdings in private funds such as Blackstone's BREIT. Just as a comparison, the $35 billion Vanguard Real Estate ETF has plummeted 26% year-to-date. Well, despite that so-called confidence, investors in the fund sent double the normal amount of redemption requests in November. New subscriptions in the fund experienced a major drop-off. Subscriptions fell to less than $500 million. That compares to $880 million in September. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.